We all recognise the importance of inflation and its effect on business operations. But do we recognise the degree to which small and medium businesses are affected? Likewise, do we too easily discount ways in which they can be supported? I'm John Basquill, I'm a senior reporter at Global Trade Review. On behalf of Taulia, Alistair Baxter is Taulia's Head of Receivables Finance. Speaking with Alistair today is Sean Edwards. Sean is Chairman of the International Trade and Forfeiting Association. It's a pleasure to have you both here. Thank you very much for joining. So to start with, Alistair, maybe we could start with you. What trends are you seeing around inflation and what are some of the causes and effects?
Yeah, so we've been talking a lot about inflation with our customers. It's everywhere. Everyone's talking about it and thinking about it. But the real challenge is what to do about it. That's the elephant in the room. A lot of inflation was anticipated. We've just come out of a global slowdown, so demand was going to pick up. That was going to bring some pricing pressure. We already knew there was going to be a shortage of containers. All of these things are driving up prices. But really in the last 6 months, we've seen commodity prices skyrocket, and that has really fueled the inflationary pressure. And ultimately, when you combine that with stalling growth numbers as demand begins to cool, we're really beginning to create the perfect storm. And that's what our customers are beginning to talk to, the fact that they've got inflationary pressure, flatlining revenue, and ultimately this is putting a ton of pressure on their working capital. That being said, in the last couple of weeks, we have seen commodity prices soften just a little bit. This seems to be coming through the futures market where speculators are widely anticipating a recession. But obviously, recessions are not necessarily a good thing. And looking ahead, looking through the next 2-3 years for financial planning, companies really need to think hard about how their working capital will best fit their needs to survive the storm.
If we look at the SMEs, there's this dictum that cash is king. And I think we have to look at that, re-examine that a little bit. And we have to say that the cash cycle is king. And actually what's really important, and I think what the current inflationary environment has shown, and I take a little bit of hope from what Alistair said, that things are beginning to tail off a little bit. But there's still a huge amount of uncertainty around. And I think that's that on top of staffing problems, whether that's due to Brexit or it's due to other geopolitical factors, we don't have time to examine today. But what that means is those small companies really have to use this, the asset that all of them have, but very few of them actually properly exploit, which is their cash cycle, their payables and their receivables. And that with money essentially becoming less valuable, that's really accelerated the need to do that. So, in basic terms, the higher the inflation rate is, the less money is going to be worth very quickly. So you need to recycle that cash and use it quickly. That also means you need to get the cash in, but you also need to spend the cash. And so actually, in a way, what the current inflationary environment has done is put a little bit of a discipline on something which has always existed. But the need really to speed all of this up because of inflation, I think, points the need to really improve the practices that SMEs have had, and it's very hard for them. As I said, the bigger companies have got a lot more options. Usually they can set up payables programs, and of course that's very helpful for their suppliers. But if you happen to be a supplier who either isn't going to be able to get on one of those programs, or who not fortunate enough to have a buyer who's doing that, you have to sort of do it for yourself. And I think people are having to wake up very quickly.
So, Alistair, just sticking to SMEs for now, what strategies or what options would you say are open to companies who are grappling with these inflationary pressures?
Inflationary pressure is not consistent the world over. We are seeing a bit of an APAC trend that's different to what we're seeing in North America and EMEA. So focusing first on APAC, we are seeing a lower rate of inflation there. The Asian economies have responded to the COVID crisis in a very different way. That being said, they are still faced with the rising commodity prices that are biting into economies elsewhere in the world. So central banks in APAC have probably taken a slightly more balanced view on how to react to this, how to use their monetary policy to affect change. And they're probably more balanced in their view of unemployment as a factor, and their kind of view on cost of living. Whereas I think in more Western economies, there's more immediate pressure to curtail the rampant inflation. I think if we then switch our focus to Western European and North American markets, all of our customers are talking about cost push inflation. They're talking about the rising input costs, and this is big customers and small customers alike. They're talking about the rising cost of borrowing as interest rates move up, and they're talking about flattening customer demand. So all of that is bringing quite a bit of strain with it. And if we kind of then split that into kind of larger customers and smaller customers, we begin to see some more nuanced effects come through. So on the kind of whole, we're seeing margin erosion, but that's particularly pronounced when you look at the smaller customers who are facing steep input cost pressure. So they're seeing their cost of inputs, their electricity, their fuel costs going up, but quite often they're not large enough or dominant enough within their supply chain to pass that cost on to their customers, who are often another business and not a consumer. So that's really causing a lot of pressure on the margin, and it's forcing some difficult decisions on sort of small and mid-sized companies. Another problem we're seeing more in the mid-market is the build-up of inventory. So there are a number of companies in the mid-market who are suffering with indigestion with the level of inventory they're holding right now. The world has moved from a just-in-time model where efficiency was the most important thing, delivering goods at the lowest cost, is moving to more of a just-in-case model where higher levels of inventory are desirable to make sure they're always there to capture any market demand. Obviously, the more inventory you hold, the more of a drag on your cash it is, the more of a drag on your returns it is. And this is causing real problems for companies managing their working capital. And this really brings us, certainly for smaller companies, to a bit of a fork in the road when it comes to setting their strategy. What we're hearing on one side is that companies really want to hunker down. They want to trim their cost. They want to focus on their core business and plot a path to survival for the next 2 or 3 years. On the other side, we're seeing some companies take a very different approach and look to find areas of growth. They want to innovate. They want to change their marketing strategy to connect themselves with new markets and really push for sales so that they can beat the level of inflation. And you've got two very contrasting strategies. However, behind both of them, there's a very clear need for working capital to fuel that strategy.
So looking at the numbers, the annual inflation rate in the Eurozone increased to a record high of 8.6% in June 2022, while in the US it accelerated to 8.6% in May, the highest since 1981. APAC's rate is more moderate, averaging around 4.5% in the period between January and March 2022. What does this mean for businesses, both large and small? What options are available to them?
If money is less valuable, you need to actually use that very quickly. And as I say, I think it is really we're at a time now where small companies have, in a way, they've been pushed up against the wall, that's true. And maybe that's a bit unfair. But they actually do have a lot of tools. Everybody has this inherent asset, which is their billing cycle, their invoicing. And I think it's time to make better use of that. You need to use that money quickly because, of course, the cost also of your inputs is going to go up very fast, or faster than you originally anticipated. That might mean that you need to buy earlier. It means that you'll need to place orders up front, try and fix prices. That will require down payments, and I think that's something that's probably for a lot of SMEs that have lived a little bit hand to mouth, that sort of discipline I think is pretty tough. But it needs to be done now more than ever. And we're also in an environment, where I think the consumer is very demanding. The consumer market is actually very tough. So the end users are demanding more, and to be able to stay in the game, you've really got to get on top of, I think, also investment in your product, in your business. And I go back to the point that, credit is expensive. There's a lack of equity finance for a lot of SMEs. And so you've got to look at what the assets are. And the asset, which every company has, I'll repeat the point, but I think it's really important. The asset that every company has is their billing cycle, is their cash conversion. And I think they need to make better use of that.
What are your thoughts on those businesses taking on financing to manage the impact of inflation?
So on that point, for the last 5 or 6 years, we've seen small and mid-sized companies take advantage of low debt pricing in credit markets. If we kind of look at historical averages, the proportion of debt in capital structures is more or less an all-time high, which was manageable when we were in a lower for longer rates environment. But as we come out of that into a slightly higher rates environment, that begins to put a little bit of pressure on cost. And I think actually that there's a bit of extra detail here that we probably need to dig into. So in times of economic volatility, we see spreads widen between investment grade and non-investment grade companies. So I guess what I mean by that is that investment grade companies will see their cost of debt rise, but very moderately, whereas sub-investment grade companies will see their cost of debt rise quite substantially. The gap between investment grade and non-investment grade is getting wider as volatility comes into the economy. And in addition to that, we're seeing benchmark rates move up. So the central bank of the majority of developed economies use a mechanism called forward guidance, where they tell the market ahead of time how they're going to change rates. In a lower for longer environment, that works really well. It brings stability. But somewhat counterintuitively, when volatility returns to the market, it actually makes central banks lag behind the inflation curve, which sometimes creates challenges for businesses where they're trying to fund themselves as efficiently as possible. So if we look at the economy as a whole and where the pain is being felt right now, for small businesses, they'll quite often cite rates as being a pretty crude instrument where the overall price of debt changes, but it's coming in at the top. It's not necessarily where they need the capital. And given it's nearly 40 years since we've been in a rates environment comparable to where we are today, a lot of innovation has taken place. A lot of technology has entered the world of financing that allows small and mid-sized companies to access capital and liquidity where they need it. So instead of pouring capital in the top, it's being inserted at the exact point in the supply chain where it adds value to their business. And linking that to the earlier point of credit spreads widening, where small companies are supplying goods to larger companies that are investment grade, they can take advantage of that rate differential by using a supply chain finance or receivables finance program, where they can access capital at a lower cost than they would if they were trading on their own risk profile. So there's definitely some benefit in there. And where small and mid-sized companies use the assets that they have to access capital, by applying technology, by working with funders, you can do that quite efficiently. So there's definitely an opportunity here. It's not all doom and gloom.
This widening spread between the good credits and the lower credits, and you mentioned things like inventory that have become sort of difficult to finance. And I think really what that leads us to talk about and to consider is the wider proposition and the wider benefits of supply chain finance. At the core of it, of course, is the optimization of the cash conversion cycle. But there are different tools that are applicable for different problems and for different sizes of companies. Inventory very often for the big manufacturers is a problem. The receivables and payables side of it, I think, is very interesting. That those are separate tools that are available to different sizes of companies. I think essentially receivables is available to everybody. Eventually, of course, the cost of that will be keyed off the eventual risk, which is the buyer. But I think what I'm seeing a little bit of a trend off here, and it's partly caused by the factors you mentioned, but also by geopolitical stress, actually is the need really to look at and consider the integrity and the safety of your whole supply chain. So take an example of a deal that I worked on many years ago for a big car manufacturer in this country. We had 27 different subcomponent suppliers across all over Europe. Now, you think about, and this is a long time before even Brexit. But if you think just one component is not supplied, you don't have a car that you can sell. You can't have a car without a steering wheel or without a bonnet, whatever it might be, without plastics, without seats. So and I think now, and we've seen what's happened, to take that example of the automotive industry, with Ukraine, which was, unbeknownst to many people, was one of the biggest suppliers of electrical harnesses for cars. That caused a huge problem. So there's a lot more for security reasons. There's a lot more security both in the wider political sense and in the business sense. I think there's a much more of a consideration now about continuing the safety of your supplies. I think, to go back to the point you made earlier about, there was a problem with, for example, containers beginning of the year. I mean, that seems like an easy problem to solve now because we've got much bigger issues, and that seemed to be alleviating. But I think a lot of this is now reached the top of the agenda. There's a cost to that, a cost which some companies are willing to bear. And I think what I'm seeing is, more buyers, at least the big buyers, considering how they improve the appeal and also the appeal of their programs to their suppliers, and bringing in that fabled long tail. And there's all sorts of, you mentioned technology, that definitely is one of the ways in which that long tail can be brought in. I think we've also got to look at the KYC AML environment. That's a big reason why that long tail doesn't get brought in. But the current environment is actually focusing people very sharply on these issues.
And to your point, John, on smaller customers, there's a couple of very clear trends that we're hearing come back. I think first of all is where small suppliers are trading with bigger buyers on an open account basis. So in other words, they invoice on 90-day terms and wait for payment. They're essentially funding that invoice at whatever their cost of funding is. So that's a combination of their debt pricing and their equity pricing, which for small companies is normally well into the double digits as an APR. So that as a kind of drag on returns is quite meaningful to a lot of small companies, and they're beginning to look for other ways to fund that, to improve their cash conversion. Time to cash is more important now than it has been for an entire cycle.
Especially when, as you say, inputs are becoming a lot pricier.
Indeed.
Very, very quickly indeed.
In fact, in many ways, small companies are trying to recycle their cash to buy inventory and hold the inventory as a hedge against inflation. Yeah. So we're definitely seeing more velocity in the cash conversion cycle, or at least demand for velocity. And the second thing that we're seeing is obviously, we spoke earlier about the potential of a recession coming. I think odds on there will be a recession of some form in the majority of economies towards the end of this year. And with recession often comes customer default. And this is something that's beginning to weigh on the mind of small and mid-sized companies, where they're very dependent on their 1, 2, 3 largest customers. And if one of them were to default, that would leave them in a very sorry situation. So they're beginning to look at other options to protect themselves against that, whether it's receivables financing, whether it's an insurance line, but essentially being able to mitigate the risk of their key customers is a talking point that perhaps 2 or 3 years ago, when there were stimulus packages, when there was growth in the economy, that weren't really a factor. So the tides have changed. It is a different world that we're looking at today.
So moving to the larger end of the market now, we've touched on some of these points already, but what are the options available to larger businesses in terms of working capital, and how do those options kind of influence the wider market?
Yeah, so look, I think I've touched on this already a little bit, which is the holistic nature of supply chain finance. And all the different tools that are available. But when you talk about the larger corporates, what they're really looking at is the ability that they have, of course, and they're great power. And I've already said, one of the reasons why they're choosing to do this. But it's their ability to set up payables programs, reverse factoring programs, supply chain finance, or whatever you want to call them. The GSCFF, which you mentioned earlier on, we call it payables finance, to ensure the security of their supply chain. But they're also looking at the sort of the inherent finance capacity in those programs to do things that actually are a bit of an evolution of traditional supply chain finance. So certainly what I've seen a lot more of recently is using payables finance really as a little bit of a sort of project finance light kind of finance. And of course, for those in that case, what it means is they're looking very much at the DPOs. They're looking very much at stretching out the payment terms, sometimes very significantly. And that becomes effectively a sort of bank debt. Be careful here because there's lots of issues, of course, around how you categorize that, and a lot of the accounting reforms that are going on have addressed themselves to that without landing quite yet. But we think we've come to a pretty good landing, which is favourable, I think, for corporates and for banks who are supplying SCF facilities to them. And we've mentioned inventory finance as well, which is something certainly I've seen a big uptick in interest in, getting that off balance sheet. So even if you're a big company, you are very conscious about the rating agencies, about analysts looking at your balance sheet, at your financing statements. You're very careful about how your rating is going to be, analysed by maybe more than one rating agency. The great thing about most SCF tools is that you can switch this on really pretty quickly. And there are, as I say, evolutions. There are more creative ways of using these traditional tools. So it's a combination of that plus their ability at the bigger end to actually, and their need, the compelling need now to ensure that the supply chain is secure. Otherwise, as I said, case of the car example, it's just one supplier needs to fail and you don't have a finished product.
Yeah, so we are seeing the rule book of trade torn up here. Even before the Ukraine conflict and the cost of living crisis, we were seeing a changing trade landscape with Brexit, with the trade tariffs on commodities and base metals between the US and China. So there was already a change afoot. The global pandemic accelerated that. And what we're seeing now is that the C-suite of global corporates are looking to surgically and scientifically redesign their supply chains to hit the goals they want. For example, dual sourcing, to Sean's point earlier, dual sourcing is becoming much more common where single points of failure are being taken out of supply chains. We're seeing global companies move away or at least reduce their dependency on autocracies and move to economies that share more common goals with their own. So we are seeing change. And with that change, there's a big shift in outlook. Supply chains are going from being the most efficient route to deliver a good to the most secure route of delivering a good. And that's quite a fundamental change in the way that C-suites look at things and the customers of those global corporates. This obviously is putting pressure on returns. So if you're not generating the cash, if your margins are under pressure, if you can't pass your costs on, your returns are going to suffer. And this is something that is a real talking point around C-suites. If a large part of your incentive package is derived from your ability to generate returns, there's quite a big incentive to find a way to improve your working capital. And that's where receivables finance, supply chain finance, essentially anything that allows you to optimize your net working capital position becomes really useful at this point in the cycle, because there's no margin growth, there's no clear revenue opportunities. It's really all about making sure that you've delivered financial efficiency in the way you run your operations. And that's where technology and financing really comes together quite nicely. I think also there's a kind of once in a generation opportunity here when we're redesigning supply chains to build them in a future-proof manner. So everybody is talking about ESG today. And by building ESG credentials into the supply chain, you know then that it's going to be set up for the world tomorrow. And this is something, again, that more and more is being looked at. And by incorporating incentive structures in SCF programs, we're seeing the uptake of that move pretty quickly. And on the other side, obviously that's the customer side. On the investor side, we're seeing quite a lot of interest in this. So within our multi-funder network at Taulia, our investors are saying that more and more they want to see ESG assets created. EY, the global advisory, are suggesting that 3 out of 4 investors today expect to see an ESG position for any company that they invest in. Deutsche Bank have said something very similar, that by the end of the decade, they reckon 95% of all investable assets will have been ESG scored. So the time is very much now to start thinking about incorporating ESG credentials into your supply chain and creating incentive structures to drive the right behaviour, not just within your own business, but within all the businesses in the supply chain that lead to the finished goods.
Yeah, and it's worth just adding on ESG, which is that it's an ethically a very good thing to do, but there is a certain amount of compulsion that's going on, legal compulsion. There's a lot of regulation now on banks in terms of taxonomies, reporting regulations. That means that, regardless of your view about whether climate warming and all the rest of it, banks actually are being forced to do this. And it's part of, it's very much a carrot and stick approach. In a sense, I think it's a good thing, what we're trying to achieve. So at the end of the day, we have the result, and it's a mixture of the two. It doesn't really matter. But that's the funders that are coming onto your program are also in part being motivated by this. And I think we have there's a lot. If you look at what's coming up on the horizon, what's happened in the US, the tightening of the European regulations, the increase, whatever happens with the next government in this country, increasing, effectively paralleling what's happening in Europe on ESG in terms of taxonomies and regulations, that's going to be a major factor as well.
Right, so Alistair, I'll ask you first. What is the one thing you would hope our audience would take away from this today?
Good question. So I think we're at a fork in the road. Companies, big and small, are faced with the option of slimming down and weathering the storm, or looking for growth. And I think whichever strategy they want to employ, working capital is going to be the fuel to make that strategy work. So think about working capital, think about how to use working capital to make that strategy really land, would be my one thing.
Excellent. Sure.
Can I be greedy and say 2 things? So one's a development of what Alistair said, which is I think it's an asset, the ability to use SCF in some form or working capital finance is something every company has. If you're a small company, you've got receivables, assuming you're still in business. If you're a big company, you've got receivables. You've also got the ability to set up a payables program. And the second point I want to make is to use this creatively, is to use the working capital industry creatively, because it's getting a lot more creative. I've mentioned, a couple of things, but I think we're seeing this as being, as being a lot more inventive than it ever has been.
Excellent, thank you. Well, I think that's a perfect note to end on. I'd like to say a huge thank you to Sean and Alistair for a candid and an open conversation. And of course, thanks to everyone for tuning in and watching. Thanks, goodbye.